If you're around 7 to 10 years out from retirement, you may want to consider this 401k strategy. And whether it's $50,000 or $1 million, the same principles can be applied to you. We'll start with the strategy, then we'll look at a real example. Now first, most people are aware of the traditional strategy where you can take a 401k and turn it into some form of retirement pension or annuity. You can also do the same thing the other way with a lot of pensions, where instead of taking the money as a guaranteed income stream for the rest of their life, instead they'll take it out as a lump sum and roll it over into an IRA. So you can roll a 401k into a pension, and with most pensions, you can roll those out as a lump sum into an IRA. Now, while this may be a great option for many people, the optional pension that we're going to talk about today is not the one where you typically roll your 401k into some form of annuity. You defer it out 7 to 10 years and then you turn on your income. It's there for the rest of your life. And that's how it works. You're going to receive the income. That was the plan from the very beginning. But instead, because for a lot of people, deferring that out for 7 to 10 years and being set on taking income can be a bit intimidating. What if they change courses? They don't want to turn this into guaranteed income. If they have other income somewhere else, they're not going to need this. They'd rather it just continue to grow. Maybe they're going to want to pull all of this money out and focus on growing it to leave behind the kids. That is where today's strategy comes into play, which is the optional pension. So how this works is it is a deferred fixed index annuity, similar to that strategy that I described before. So you see there's the 401k here. You roll that in to the fixed index annuity. That money is going to grow safely, meaning that you cannot lose due to market downturns in the next 7 to 10 years. That would also continue after that if you would like it to be. And then after that point, you have a choice. This is what we call the options when using fixed index annuities. So there's 3 main ways to set them up. In this structure, the one we're talking about today, first is you can turn that into a guaranteed income stream. That's the pension side of things. But if you don't want to do that, or you weren't sure if you were going to do that and you went with this choice, you also have the option to let that money continue to grow the same way that it did those 7 to 10 years before you reach this point. Then, if you do continue to let that money grow, at any point, you can then switch and go back to turning it into the pension. Once you turn it into the pension, though, and you have that income coming to you, you could still surrender the policy, take a lump sum out, take withdrawals, and lower the income. However, if you're going to turn it on for the income for the rest of your life, usually it's not going to be the wisest decision to do that. So ideally, when you turn it on, it stays on. Now, how is this possible? That is through what is called indexing. So we're doing this inside of a fixed indexed annuity. Essentially, you have your money in your 401k. You would have rolled that money over into the fixed index annuity, and now that money is going to start to get credited interest. So the example we're going to look at here in a second, there's $180,000 in premium that is going into this annuity. The insurance company, the same way that a bank is able to credit you interest on a high yield savings account, is going to credit this $180,000 interest. Now with that interest, you can either keep it and let that continue to compound, or the insurance company will use that interest and that interest only to buy options. Essentially, what this allows you to do is link to an index. So think of the S&P 500, for example. Linking to an index does not mean you're investing in the S&P 500. It means that you are going to track the performance of that index up to a cap and down to a floor. So if the S&P 500 had a cap rate of 8% and a floor of 0%, you will match whatever the S&P 500 does, given that it's inside of that range. So if the S&P 500 goes up 10%, well, that's a little outside of your range, so you're going to hit your cap. If the S&P 500 went up that 10%, you get credited 8. If the S&P 500 does 5%, it goes up, that's in between the 0 and 8%, so you will get 5%. If the S&P 500 goes down, let's say 20%, you are going to get credited 0%. That's because it's not within your range, between 0 and 8. That's going to continue year over year. After the gains are made and they're locked in, if the market goes down the next year, you aren't going to lose those because the market went down. Each year you make a gain, it's locked in, it's reset. You begin to track the performance of the S&P 500 again, as long as it's within that range of a 0% floor and an 8% cap. So now let's look at a real example. Oops. So here we have the net worth breakdown of a hypothetical situation, and what we're going to be dealing with here specifically is this $180,000 401k. There's also some other money here that you can pause and feel free to take a look at, but we're wondering if an optional pension would make sense for this money. This person is 10 years out from retirement age 55, could work longer than that, and if they do, that's just fine. But let's take a look. So this is illustrated at a 5% rate. You can see those on the left there, the variable returns that we illustrated that. A lot of zeros here. That's because when the market goes down, they're not going to reflect a gain because of that. Now, I didn't use the specific index that we went over with a 0% floor and an 8% cap. You can see some of those are actually higher there, but the point is the contract value, or you can look at the surrender value. That's what you could actually surrender the policy for if you wanted to withdraw everything. That number is continuing to grow over time. So after 20 years, if it grew at this rate, you see they're left with $367,000. They never decided to turn it into income. They just let it continue to grow. Now, what if we got 10 years in there, so it was about $243,000, and we decided after that we were ready to take income. So after 10 years, you see that $243,000. If we go over here on the right, the very next year, they're going to allow you to take a 7.48% withdrawal rate into perpetuity guaranteed. It's not going to adjust for inflation with the specific company, but that is turned on. The $18,000 continues there until you pass away. You can also set it up differently if you want to do a joint income with your spouse, to where even if you pass away, the spouse continues to receive it and vice versa. You can take it single. Of course, if you take it single versus joint, you're going to receive a little bit more. And at any point, still while you're receiving this income, so let's say 5 years in, you still have a surrender value. So at this point, if you wanted to cancel, you wanted to take out a lump sum, you can still do that. So it's not like the more traditional annuities where once you turn it on, you're receiving it. There's no canceling. If you pass away early, there's no death benefit that's going to your heirs. It's not like that. You can see there's still a death benefit. So if you passed away with this illustration, after 10 years of receiving income, that's 20 years after you bought the policy, not only would you have received all of the money you put in back in income, but there also is that $122,000 death benefit to pass on to your heirs. Of course, the idea with this strategy, if you're looking at the numbers, is not to try and outperform the market, but rather for those who are wanting safety, wanting peace of mind, as opposed to swinging for high returns in the stock market in a 401k. You might have been okay doing that when you were much younger and funding your 401k over the years, but as you get closer to retirement, you realize that there is a sequence of returns risk, for example, that might have a much bigger impact on your retirement and how much money is going to be there to live on. That's where sometimes people are going to be willing to sacrifice some of those returns in exchange for some guarantees. And in this case, you're not necessarily setting it up for, I definitely am going to take this as income, but you have that choice in the future. Am I going to let this money continue to grow? Am I going to turn it into income? If you do let it continue to grow, you still have the choice at any point to turn that into a guaranteed income stream for the rest of you, and if you choose to, your spouse's lives. Hopefully this video was helpful. If it was, please do subscribe. I release videos twice a week going into all things retirement, different strategies with that, mostly for US residents within 10 years of retirement who are looking for peace of mind, guarantees, not so much willing to gamble in the stock market. If that's you, subscribe, and I will see you in a future video. Bye-bye.